Okay. Uh, Sadiq, you are the one, right?
Yeah, good evening.
Good evening. Okay. I want to try to reach Ikma. Okay.
Okay, okay,
Mm,
okay,
mm, mm,
okay.
mm. So I want to try reaching Ikma. I don't know why she's not joining. Hmm. Hello? So we
Hello, have
should
you
be,
started the YouTube live stream?
I think so. I think so. So we should expect Dr. Idara soon. So, sorry, we will be having the first speaker is available already. Oh. Let me share the distance with him. Okay. That is Mr. Kuye. Mr. Kuye, Kuye, Kuye. Uh, so, Mr. Kolade, please confirm if the YouTube is okay now. Can you confirm that? If the speaker and every other thing is okay, please, you can help
Yeah, let me
confirm.
check now.
Okay.
So, Mr. Mufta, can you admit Miss Ikma?
It's not, it's not showing here. It's not showing that she wants to join. Tell her to join again. It's not showing from the back end here. Please test run the YouTube. Test run the YouTube. So, Mr. Kola, have you confirmed the YouTube so that we can start?
Sorry, I'm on it.
Okay, okay.
Sorry, can you speak? Let me know.
Okay, try now.
I think it's lagging behind. It lags behind, sure.
Okay. Lagging behind. Infonet. I don't know if you are still there, sir.
Yes, I'm here.
Okay.
So it's normal to lag. If you lag like few seconds.
Okay,
So
okay,
that's
okay.
not.
So please ask Ikma to join again, please. Okay. Okay, so good afternoon. Oh, I need to. So good afternoon, everyone who has made it to this conference. You are all welcome to Founders Growth Conference Founders Growth Conference is not just a webinar, it's a section that has been prepared for business founders. I am very certain that you will get the value you are looking for. We have powerful facilitators, and then let me just do a short introduction to this program. So basically, this conference is organized by Omcable Innovate. And Omcable Innovate is a brand. We are focused. Our focus is business branding, that is looking at businesses and what it takes for each business to be well projected. Sometimes we call it visibility. The reality is that for every business to thrive, or for major business to thrive, you need some level of visibility. We have some brands, or we have some companies that the kind of service or the kind of product they do, they don't really need online visibility. Even though those kind of brand have their way of doing their marketing and as it relates to their business, but the focus is for business who are product business and service business who need visibility to thrive. And I want to believe that 90% of businesses need this sincerely. So I want to welcome you to this special event, Founders Growth Conference. And then the Founders Growth Conference, just like I said, it was born out for the fact that we want to answer questions that our audience, or the challenges our audience are facing, or the challenges that businesses are facing. So it is necessary for us to, as a company, we are positioning to answer some of those questions, or to try to help businesses who will need this. And then this is the perfect place for all of us to be. So for the next couple of weeks, this week, next week, this week's 21st June 2025, next week, Saturday, 28th June 2025, and the last week, which will be July 5th, 2025, we'll be having powerful facilitators. So we'll be having powerful facilitators who will be joining us, who will be in this room with us to help business. So yes, this event is free of charge, but from the initial of the planning, we want to make this event is planned to be free, but however, it will be very distinct. We want to try as much as possible to scrutinize the kind of guests, or the kind of funders that we bring into this program. But in our own goodwill, we later thought of opening it to all. So all of you currently joining, or that you are listening to us at the moment, count yourself to be lucky to have this opportunity. So Mr. Kolade, please, can you confirm the YouTube is still very much okay? Okay, so for this week, because of our time, we go straight to the point. So for this week, we'll be having two amazing speakers. And then our first speaker is a renowned scholar in the field. So one of those things unique about this conference is we've carefully selected those we want to bring on board, and then we've brought in, or we'll be having in the room, different people from different areas of business. We have some of them in Nigeria, we have some of them outside Nigeria. So today we'll be having the first section. For this section, we'll be having Mr. Abdulkabir Taiwo Kuye, FCA, FIPP, FIFP. I'm very sorry, sir. So FCA is so please can you see confirm you can hear me, please? Mr. Kolade?
Yeah, I can hear you. Good evening.
Okay, good. So FCA is so I wanted to say founder. So it's fellow chartered accountant of the Institute of Chartered Accountants. So and he's a senior manager at advisory service, one of the big four firms in the country. I have this singular honor to okay, let me just share my screen while I read this citation. I think the citation itself will assist somebody else. So okay, so we have the speaker, Mr. Abdulkabir Taiwo Kuye, and then he's just like I said, he's a senior manager, advisory services, one of the big four firms. So Mr. Abdulkabir Kuye is highly accomplished finance professional with over 12 years, that is over 1 decade of experience delivering strategic financial solutions across diverse industries in Nigeria, Africa, and beyond. As a trusted advisor, he brings a wealth of expertise in financial services, consumer and industrial markets, oil and gas, manufacturing, and telecommunication. So, with extensive experience in accounting, bookkeeping, and financial reporting, Mr. Abdulkabir has successfully led engagement that several businesses streamline financial operations, enhance reporting accuracy, and ensure compliance with global standards. So one of those things is we are not just talking about a Nigeria standard now or a standard that is not globally recognized. So his proficiency spans setting up accounting system for startups, leading finance Okay, I think the network logged me out. So please can yes, we can hear you now. Okay, good. So Mr. Kebi Kuye holds a Bachelor of Science in Accounting from University of Lagos, following an HND and ND in accounting from Lagos State Polytechnic, Ikorodu. His passion for financial empowerment and strategic advisory makes him a sought-after speaker at industry events, where he shares valuable insights on financial management, reporting standards, and business transformation strategies. So, permit me to welcome or with a digital innovation. So, I think we are in a physical event now. Then I would say we should stand up for him. So, but with a physical, with a digital appreciation, let us appreciate Mr. Abdulkabir Kuye as he will be taking us through financial literacy for non-accountant CEO. So thank you very much, Mr. Abdulkabir.
Okay. Good afternoon, everyone. Please confirm that you can hear me and you can see my screen.
We can hear you, but yet we are yet to see your face. I want to see that face.
Oh, can you see my screen?
Yes, you can see your screen. You can see your screen now.
I confirm that you can also then see my screen now.
Oh yes, we can see you now. We can see you now.
Okay, thank you very much. Okay, so good afternoon, everyone. My name is Taiwo Abdulkabir Kuye, as previously mentioned by my brother, Mr. Miftah. And it's an honor to be here today to speak to, founders, entrepreneurs who are making the Nigerian market and economy continue to exist. Because I believe that entrepreneurs who are converting resources to cash, to put it that way, are those that are really, really making the economy work. In addition to government policies and government support, as you may argue. But then it's a pleasure to stand before you, to sit before you, to discuss about financial literacy for non-finance CEOs or non-finance executives, maybe non-leadership CEOs. However, executives, those in leadership position, who most are often not and really not financial people, but are not finance professionals. So there's usually a different world entirely of those of us who are finance trained, and those of us who are entrepreneurs who just want to convert knowledge into processes and then get results. We just want to solve problems that we commercialize solving problems. It's for you to identify what the problem is, come up with a bankable solution, run with it, make your money, and then cool off. But then, you're most often stopped by your accountants. So there's one thing, there's a financial report that's supposed to be prepared. There's what we call a profit or loss. There's something they call balance sheet. There's something they call asset liability, and one of those jargons that those guys just talk about. So to give us a few basics that is expected of those that are not financially trained people. That what's this asset they're talking about? What's liability? What is revenue? What is sales? What is cash? What is profit? Because most times people say that what I have money is my profit. But what is really profit? What is cash? So I'll just take us through all of that and see how much time it permits me for us to run. I think my outline is really just to discuss what's the responsibility, what's the financial responsibility of you as a director, either as a CEO or as a director of an organization, what's your core financial responsibilities are, and then what are the introduction to accounting fundamentals, what are those basics that you should know, what are the components of a financial statement. When we say a financial, what does it look like and what are the components? How do you then analyze financial statements? What's the need for you? When you say this is a financial statement, what do you want to look out for? What's important to you? How do you make sense of what a financial statement is as an owner, as a director, as a CEO? And what are those early warning signals that you should look out for in a financial statement that should make you sit up to say things are going south? What are those things I need to see? Because when a company goes down or falls up, it doesn't just happen in a day. Series and series of activities must have been giving you those signs for you to identify those issues. And then if time permits us to look at how to connect budget to financial reporting and how to enable controls, financial controls within your business. If this was a classroom and then I would have asked about to say what's your statement of your knowledge of accounting and financial reporting related matters. So do you have no knowledge at all? Do you have basic knowledge? Do you have intermediate knowledge? Or do you have advanced knowledge? This usually guides me in seeing how granular I should go for in terms of if there are people with either more basic or no knowledge than people with intermediate or advanced knowledge. So what's the responsibility? What's your financial reporting responsibility as a director? So what are the responsibilities of the CEO or the directors in terms of financial reporting? Firstly, the responsibility of keeping accounting records that are sufficient to show and explain the business transactions of the company, as well as disclose with reasonable accuracy the financial position of the company, lies with you as the CEO or as the director. Forget that you have employed an accountant. The person that authorities will hold responsible is the director or the CEO in this case. The responsibility of keeping accounting records that is sufficient enough for you to be able to explain what this transaction is. That entered into a transaction of 1 billion. Is that maybe you sold something or you bought items. The responsibility to keep record that will explain this transaction and that will also make you disclose the reasonable accuracy of those of the financial position. This is your financial position. This is where I am as of today. The responsibility to explain those lies with you as the director or as the CEO. The responsibility of preparing a financial statement that follows the standards, that follows the accounting principles and policies, and follows reasonable judgment, that in conformity with the standards, forget the jargons of financial reporting standard, that's just the body that's responsible for preparing financial statements and the requirements of the Company and Allied Matters Act. Because once you set up a business, you register with your CAC and you are bounded by the CAMA, Company and Allied Matters Act. So CAMA requires, which then empowers the Financial Accounting Council of Nigeria, FRCN, to demand that you prepare a financial statement in a standard format. And that standard format is the format that is set by IFRS, International Financial Reporting Standards. IFRS, like they call it, is just a list of standards that tells you if you buy something, this is how you should report it. If you are owing somebody money, this is where you should put it. If somebody is owing you money, this is where you should put it. And so that you will not be like the senator that was adding the receivables of 103 trillion of NNPC and the liabilities or the payables of 107 trillion of NNPC, and said that NNPC is exposed by 210 trillion. Because a financial person knows that you are not going to access to. Someone is owing you 103, another person is someone is owing you 103, you are owing other people 107. You know that your exposure is just a net exposure, which is 4 trillion, not the 210 trillion that the media taking to the market today, just to get people to read the news and all of that. So the responsibility for preparing your financial statement that in line with this standard, and the standard is guiding you on how to prepare your financials, lies with you. Either you're an accounting expert or not, the ultimate responsibility lies with you as the director. Also, the third responsibility that has been charged to a director, that you must ensure that the appropriate internal controls that are established to safeguard the assets of the company and to prevent and detect fraud and other irregularities. So it's a responsibility to put controls in place that will help you safeguard the asset of the company. The asset of the company is your cash, your properties, your business model, all those things that make your company running today. You must put up controls to safeguard those assets. And you must put up controls to prevent and detect fraud. This is not the responsibility of the auditor. Sometimes you say you bring auditor, the auditor come and help us detect fraud. It is not the responsibility of the auditor. I'm sure it will come as a shocker to a number of people who are not finance related. It is not the responsibility of the auditor to prevent and detect fraud. It is the ultimate responsibility of directors or owners of the business to put up controls in place to start, and also put up controls in place to prevent and detect fraud. when they are put in place, either those controls are sufficient enough to prevent and detect fraud. So when they test those controls and they say, this control is weak, they now begin to show you evidences that this control is weak. This fraud here, see this fraud here, see this fraud here. This money did not go to the customer. This money did not come from Kineko. That's what the auditors has come to do. They've come to tell you that the controls they are put in place so is not sufficient enough. And these are the evidence that is not sufficient. They now start passing you audit adjustments, or they now start telling you that there's theft here, this is missing here, money is missing here. But it's not their initial responsibility. Their responsibility is to come and test your controls. And the responsibility of setting up controls lies with you, the directors. So, there's a flag I wrote here that directors are statutorily imposed with the responsibility of preparing the financial union of the company. So you ask that, how can I be responsible for it when I'm not a finance person? Today I got an accountant. That's what you said. You got an accountant. But like lawyers will say, he said that you can't transfer responsibility, you can't transfer rights. Delegatus non potest delegare. I still remember the legal termination there that someone that's been delegated upon cannot transfer that delegation rights to somebody else. It is your responsibility that's been delegated upon you by law, being a director or an owner. You cannot transfer that responsibility. That government can only share the responsibility in terms of helping you do the work, but it's you that will sign off on the financial. So look at the financial statement of organizations, the directors, the MDs that signs off. It's not the accountants who prepared the report for you. They are the one that's assuming responsibility for it. So it means that you need to have a fair understanding, a fair knowledge of what the guy has done before you can put your signature and sign on it. So like I said, it's not just the finance director, or it's not just the finance accountant that's responsible for the preparation of financial statements. It is every director. The CAMA says that in the case of every company, the director shall, in respect of each year of the company, prepare financial statement of the year for the year. You see, CAMA did not even say that it is a financial accountant or a finance director. All directors say it's a responsibility. The directors shall, in respect of each year of the company, prepare the financial statement. So you are responsible for preparing the financial statement. So it is you that the authorities will chase, not just the finance person. And in reality, sometimes you see what's happening in the news, where financial statements, the stock exchange is finding organizations for my financial misstatement. 15 companies flout NDC's financial reporting requirements. So all those reporting requirements is going to be, the directors are going to be held responsible, because the worst case is you are going to sack a financial person and it goes, but you are the director who owns the business, you still face the liabilities and fines and penalties for authorities if there are misrepresentations in your financial statements. So going to accounting fundamentals. So looking at the underlying business of accounting, we have what we call the accounting principles and the accounting concepts. That's the principles. Principles are those rules of action and guidelines that is adopted by accountants in recording your business transaction. So if you want to record, so you bought a laptop, for example, for the organization. You bought laptop for the organization. How do you record it? What does accounting say? What's the principle? What's the action that you must do? What's the guideline that guides you in accounting or in recording the laptops that are bought for your business? Oh, you are converting your personal laptop. You are starting your business. Your business cannot buy a laptop. You are converting your personal laptop and dedicating it to the business. You are giving the business to be used, so you have to be the business owner. How do you report that? You have rented an office space for your business. How do you report that? Somebody has bought a service from you. You have rented a service to a client. The client has not paid you. How do you record that? The client has paid you 1 year branding service, has paid you everything up front in June for the next 1 year. How do you report this? And you know that your own accounting year, your year is January to December every year. That's how you need to pay your financial, January to December. And this guy has paid you 1 year branding fee from June 21 to next year, June 20. How do you account for that? June to December is 6 months in this year. January to June is it falls into next year. How do you record that in financial? That's what accounting principles are really talking about, and as well as the accounting concepts. Accounting concepts are those assumptions that you have put when you are preparing the accounting work, when you are doing the account. What are those assumptions they are put in place, which you are going to look at in subsequent slides? So that's the accounting principles and concepts are really just those rules and actions and guidelines that you have adopted in recording your business transactions, and the assumptions that you have considered in preparing their financial records. Say that these terms are often interchangeably used in many cases. So we look at some of the accounting concepts and principles, And the first that I always like to talk about is the business entity concepts. Especially for owner-managed businesses, startups, and what have you. People find it difficult to separate the business activity from their personal activity. In accounting, the first concept is entity concept. That is, the business of the business of the business is separate from your own personal activity. You're not using your personal account. It's a personal account that you're using to pay for supplier, the same account that you're using to receive money from your clients, the same account that you're using to buy food for yourself, the same account that you're using to pay for your house rent, the same account that you're using to pay for your children's school fees, the same account that you're using to pay for the rent of the office. You have just commingled everything together. No. Financial account information relates to the activities of the business entity only and not the activities of the owners. So you as the owner, you must understand that the business stands alone. You also stand alone. Mr. Miftah is Mr. Miftah. Cable is Cable. So you must understand that concept as the first key concept in accounting. The second concept is monetary measurement concepts. Sorry, I'm trying to minimize this. It's confirmed you can still see my screen.
Yes, I can see the screen and your face.
Okay. Okay, and my slide. Is my slide still on?
Yes.
Okay, thank you very much. So the second concept is money measurement concepts. It's saying that it's only items that can be expressed in monetary terms that you can record, because accounting is naira and kobo, it's figure. So if anything that is non-monetary, and by that I mean you cannot put amounts to it. There's no how you cannot measure it. There's no how you can record it in accounting book. So you want to bring laptop and donate it to the business, and this is for the business. You need to go and find out how much this laptop costs to pay and put it in naira and kobo into the business. Oh, you want to do some branding work, you must be able to put figure to it. If there's no figure to it, there's no how you can record it in accounting. So it's called money measurement concept. You must be able to measure the transaction in monetary terms. Somebody has said that it's going to offer you a service for free. How do you record that service for free in your records? If I'm not able to put money to it, you need to put it in naira and kobo, and that's a key concept in accounting. Going concern concepts. The business is treated as if it will continue to exist forever. That's why, accountants in school, you say balance carry down, balance brought down, balance brought forward, balance carry forward. Because we know that at the end of this year, we are coming back next year to carry forward the balance that we used last year. That's why we don't eat up all your money. That's why there's something we call retained profits or retained earnings in the books. The profits we make at the end of this year, you're not eating up everything, you're not sharing everything as dividends to the investors, you're not taking everything home as the owner. You're going to leave some. You may want to pay yourself some as dividends or pay yourself some as salary, and then you keep some that you use to continue the business to run, because it's what you call going concern. It's always moving. The business is always moving. The business will continue to exist in the foreseeable future. And that's how you pay your financial statement. And pay your financial statement with the mindset that this business will continue to exist in the foreseeable future. There's another concept, it's matching concept. This is where it begins to get tricky, because this is when it starts to become accounting. Every other thing that I've said is still English. From here it becomes accounting. And what matching concepts or acquire business is also called acquire business of accounting is saying is that expenses must be matched. I'll first define it and I'll explain. Expenses must be matched with revenue for that period. I give an example that somebody has given you money for branding from June this year to June next year. For your financial year, your report is just from January to December. It means that you're only going to show as income 6 months revenue, which is June to December. Okay, 6 months and 2 weeks, if you want to be more accurate. 6 months and 2 weeks revenue is for this year, 2025. The remaining 5 months and 2 weeks is going to be for year 2026, because the guy paid you for branding from this year now till next year, 1 year. So, and you are covering the service from now till next year, June. So it means that you're going to only record June to December for this year, and then by next year, you're going to record January to June as well. So that's the revenue for this year. That's it. Then the expenses you are going to record. If, for example, you pay for rent for your office space, and landlord say you pay for 2 years, 2 million. You are not going to record 2 million as your expenses for this year, even though you have paid 2 million. So because the reports you are preparing is for January to December, 1 year, they're going to show only 1 year of those 2 years that you paid for as expenses in this year, and carry the remaining 1 year that you have paid, you put it in what we call the balance sheet for the statement of financial position as an asset, because the landlord is owing you that 1 year. You have not used it, so the landlord is owing you. So you call it prepayment. You have paid in advance. It's payments in advance. You go and keep the remaining 1 million as a balance in payments in advance. So you only record expenses that is for this year, and taking revenue that's only for this period. So that's what the matching concept says, that you are going to only show expenses for the period, and you're going to match it to the revenue for that same period. So revenue for this year is only recorded in this year. If you have received revenue in advance, even if you have not paid you, that's another example. You've offered service for somebody for this year and the person has not paid, they are going to recognize it as a revenue for this year, because it's service for this year. And you just go and record it and see the person is owing you. So you go and also show it in your liability as your asset, the person is owing you as a receivable. And if you are owing your landlord rent, or you have used the place, you still record it as an expenses because you have enjoyed the service. So you must record it. You also go and show it in your balance sheet. They are owing your landlord as a liability. Additional concept, prudence concept, is that we are prudent as accountants. People misuse that word to say that they are still key accountants. We are prudent. So prudence means here that the accountant should understate rather than overstate profits. And what that means is that you don't anticipate profits, or you do anticipate loss, and record losses. So if, for example, you have a case that you are likely to incur this cost, even if you have not incurred the cost. For example, you have a legal case, a business legal case, and from the look of the case, it looks like you're going to lose and they're going to fine you, or you've missed the deadline in your reports, and there's a fine that goes to that deadline. Standard says that the concept says that you go and recognize that loss now, even if that loss has not crystallized. Go and recognize the loss. So it's like taking the evil days forward, recognize the loss. But if they are anticipating profit in a court case, and it looks like from all indication you're going to win this case and they're going to pay you, don't recognize that income. Don't recognize that income yet until it comes. So, but if it is a loss, recognize the loss. But if it's money that is coming, don't recognize it until it comes. That's prudence concept. So that you are at a better position if it changes otherwise. If it's a loss that is coming, and recognize it now and it changes, and the loss happens, don't have any issue. But it changes, it's better for you at making a gain. But if it's a gain that you're anticipating, you're already taking the gain now, it now did not come. That means you're not going to a far worse position afterwards. That's why standard says no, don't anticipate profit, but recognize losses immediately that you think that will happen. Then consistency concept is saying that because there are so many methods that we use in accounting for different things. So many methods we use for different things. But now is saying that whatever method you choose, be consistent with that method. Don't use method A today, and next year using method 2. Third day they are going back to method 3. No, because the standard allows you to choose any method that you want, but says that you must stick to that method, except there's something tangible that's making you want to change. If you now change, you will continue to use that new change. It's not like you change 1 year, you go back to the previous one the second year. No, you must stick to a method, and then if the method requires that you change, once you change, you must stick to the new change. That's what the standard is. That's what the concept is saying. Be consistent with whatever method that you have chosen to apply. Dual aspect concept. Yes, this is also where it gets tricky for non-accountants. We say that for every debit, there will be a corresponding credit. For every credit, get debit and credit. People are always worried with this debit. Credit, even when I receive credit alert, I know it's funny because it's more like the opposite. When you receive debit in accounting, it's that money has come in. But for you, when you receive debit alert, it's like money has left your bank account. And it's when you receive credit alert that you're happy that money has come in. But in accounting, in debit and credit, when you credit your account, it means that money has left. So that needs to bust people's brain, especially people that are not accountants. That's all this grammar that people are saying. And it's not far-fetched, it's not confusing. It's just that when you are receiving alert from your bank, you're on the other side. What the bank is doing is debiting, the books. and crediting you that have received the money in your account. So actually, I still the same. It's still the dual aspect. The dual aspect is say that every single transaction has two entries: debit side and the credit side. So when somebody put money in your account, they are crediting your account, and the bank is debiting his own cash flow, his own account. So, and once you take money out of your account, they pay you. They will debit your account because you paid money out, and then the bank credits his own cash flow to show that money has left. So we call it debit the receiver, credit the giver. Debit the receiving account, credit the giving account. So that's the simple principle. But you that have received a lot, you're on the other side. For every debit that one person does, the other person does the opposite, which is credit. For every credit another person does, the other person does the opposite, which is debit. So that's why when you receive a credit alert, that money has come into your account, what the bank does is that they debit the account, the opposite. When you receive a debit alert, that means money has left your account, the bank credits. They do the opposite. So that's dual aspect concept. And materiality concept, it also holds that items of material values are accorded their strict accounting treatment. So materiality differs. For some people, 1 billion is material. For some people, 100K is very material. Materiality is saying that the impact of the transaction on your bottom line, what's the impact? But for a $1 billion business, $100 million may be material because that's 10% of his business. For a $1 million business, 10,000 may not be material, 100,000 naira may not be material. But for you that your business is no more than 1 million naira, 100,000 will be material to you. So it differs. Materiality differs. So it's just because my concept is saying that only items of material values are accorded as strict accounting treatment. Materiality principles state that an accounting standard can be ignored if the net impact of doing so has small impact on the financial element. So if you have to follow a principle, for example, or a standard or a law in accounting, and you realize that if I even ignore this thing that has no material value, I'll give an example. There's something we call depreciation, in accounting. When you buy an asset, if I buy this laptop now, I bought it for how much? 100K, for example, and I'm going to use this laptop for 4 years. Say for 3 years. Out of the matching concept, this number 4, is that since I'm going to use this laptop for 3 years, that means 2024 and 2025. That means 2025, 2026, and 2027 will benefit from the use of this laptop. It means that 2025 should not be the only one that will suffer the costs. Every year that we enjoy this laptop should share in the costs. So since I'm going to use this laptop for 3 years, I'm going to spread the costs for 3 years. 2025 will take out of it. 2026 will take his own share. 2027 will take his own share because they're going to enjoy benefits from using. But maybe this laptop I'm using to do brand design, and I'm going to use to make money. So I'll be making money in 2025 with the laptop. I'll make money in 2026 with the laptop. I'll make money in 2027 with the laptop. Why should 2025, 2026, and 2027 enjoy from making money from the laptop, but not suffer from the cost of buying this laptop? So 2025 will not be the only guy that will suffer the cost of the laptop. All of us will suffer the cost because all of us will enjoy from it. So I'll spread the 100K over 3 years. 2025 will take 33K. 2026 will take 33K. 2027 will take 33K. That's spreading the cost of the assets over the useful life of the assets. And that is what we call depreciation in accounting, which is what we do for our assets. So that means when I buy this asset 100K, I'm not going to put 100K as expenses for this year. Even though I've made payments for the asset, I'm going to put only 33K, which is the share of this year on the total cost of this asset, in my expenses, and put the remaining 66K balance inside the assets. By the time it's 2027, I take 33K out of 2026, I take the 3K out of the remaining 66K in asset and put it in expenses. So expenses are taking another 33K, assets remaining 33K balance. By the time we enter 2027, I'll take the last 33K from assets and I'll put it in the expenses. So assets will now be zero by the end of the 3rd year. Our expenses will now have taken the cost of each of the 3 years. So that's matching concept. So that's the concept. That's what you should do. That's the rule. But because when you now in your business, you bought the laptop 100K, your business is a 100 million naira business, or a 50 million naira business, or even a 10 million naira business. I bought a 20 million naira business. I bought a laptop for 100K. What is 100K in 20 million? I'll now be sharing 100K over 3 years. I think that I do that. Okay, well, it's not material, Jerry. I can expense the whole 100K in my P&L at once. I've defied a principle, which is the principle of matching concepts that I just talked about. I've gone against that rule. But because the money is not material, standard says that I can ignore that principle. But you have to be able to justify that it's not material. The standard says that I can use materiality concept to ignore that principle and just allow the 100K hit my expenses at once. You have defied the principle of matching, and because of materiality, because $100 business, $100 million business, I want to be sharing 33,000 over 3 years. What's the impact of that? I beg. Just take the 100K once, and you are going to disclose some financial statement. That's what you have done, and this is the reason why I'm doing that. So that's what materiality is saying. I hope you are still together and I've not entered too much jargons, because I'm now going into the jargons themselves. Please, are we together? Can someone confirm for me?
We are still very, very much together, and the others are.
I've not lost you yet.
Definitely, we are still coping. You are simplifying.
Okay, all right, thank you. Okay, thank you. I'm glad to hear that.
But
all right, so what,
Mr.
Yes.
Please, your time is just about. You have to stop by 6:05, please.
So what's the time now?
So this is 5:54.
I have 10 minutes left.
Yes, sir, please.
Wow. Okay. Okay. People want to learn accounting.
I know you are very prepared for us.
In 40 minutes. Is that what?
I said I noticed that you are very prepared for us, but the time constraint is a challenge now.
Okay.
Thank you very much.
Okay. I'll go faster. So some of the elements of financial accounting are all of these 5. It does not go beyond these 5: assets, liabilities, equity, income, expense. This is everything that accounting. This all the foundation that it lies on. Every single transaction cannot go beyond all of these 5. And I'll explain what each of these 5 mean. Assets are the resources that you control as a result of past events for which you are going to enjoy future economic benefits. And I'll explain. You have control over a resource. This laptop that I'm using to teach you, I have a control over it. And what made me, or this vehicle, or these premises, or whatever it is, and what made me have control over it is because of something that's happened in the past. And what happened in the past? I purchased this in the past. I bought this laptop in the past. That's the past event that has occurred. And I'm supposed to enjoy economic benefits. This laptop, I'm going to use it for working, and it's going to make me money. It's going to bring me money. It's going to flow cash into the entity. It's going to give me economic benefits. So that's the definition of an asset. Something I have control over because something happened in the past, and it's going to give me future economic benefits more than 1 year. Things like your vehicle, things like your inventory items, things like money bank account, things like your machines, whatever, those things that are resources that will last for a while, that will give you economic benefit. They are your assets. Liabilities are present obligations that you have that result also from past events. You have enjoyed the benefits in the past and you have not paid liability, and you are supposed to settle. He said the settlement of which is expected to result in an outflow. Resources will go out, maybe not money, but something will go out from you because you have enjoyed a service. So it has created an obligation on you that you must fulfill. So somebody has worked for you. He has worked for you for 30 days, and you are supposed to pay him his salary. Or he has worked for you for 30 days. You're supposed to return it with doing a design for him. Or he has worked for you for 20 weeks. You're supposed to pay him commission for the work that he has done. So he has created an obligation on you. You have enjoyed the service from him, and it is due that you must pay. As I done that I have not paid is a liability on your neck. Equity is the residual interest. When you deduct liabilities from your asset, it's your equity, and it's regularly called share capital. Capital, the money that you have used to start a business. That's the old definition of what equity is. Money set aside to start a business, but not necessarily. There's some businesses that people start and they're not setting any money aside. They have equity. So if you have your asset, all your assets, you add them together, all your liabilities, you add them together. When you net them off, that's what your equity would be. So it's the residual interest in the asset of the entity after deduction of its liabilities. That's the best definition that the standard has come from. Before, the standard give us a money set aside to start a business, but these days they don't even set money aside anymore, and they can start businesses. So it's what you're worth, what's your business worth. You need to talk your liabilities from your assets, that's your net worth, and that's your equity. And then your income are those inflow to the business, which may or may not arise in the ordinary course of activity of the business. And when it's the ordinary course, the main thing why I set up a business, if example, the main thing why I set up my business is to sell pure water. So anytime I sell pure water, money comes in. Is an income. But even if so now I have plenty money and I now want to put my money in investments. I'm selling pure water, but I have savings. I have this part is going to put in investments. And I'm earning returns from that investment. That's also income. But it's no revenue. There is a difference between income and revenue. Income is any money that comes, any inflow that comes into you, either from the ordinary activity or from other non-ordinary activities. Ordinary activities means that I'm into pure water business. Selling pure water is my ordinary activity. But investing part of the money that I have in the bank, so that it's not just going to be lying down in the bank, and putting it in other investments is not part of the ordinary activity, but it's also my income. But it's not my revenue. My revenue is that money that comes from my ordinary activity, which is that pure water. But if, for example, the fridge I'm using to ice the pure water, I now bought a bigger fridge, I want to sell this fridge. If I sell this fridge, it's an income that will come in when I sell it, but it's not revenue. Because I'm not in the business of selling fridge. So the money that comes from the sales of that fridge is not revenue, it's only income. Because selling fridge is not my ordinary activity of the business. It's just an other income. I'll just call it as other income. But my revenue is selling that pure water. So your ordinary activities is your revenue. Other activities that you do that will generate inflow for you is other income, not revenue. But income is the broader term that covers either revenue or other income. And the expenses are outflows from the business, which may or may not arise in other course of activity. Any expenses that you make, paying of salary, depreciation of your vehicles or your assets, paying for rent, paying for goods and services, paying for anything, those things are your expenses. Thin line between expenses and assets is that even though I am paying for assets, but those assets will last for more than one financial year for you. They will last for more than 12 months. Expenses are those things that will not last for more than 12 months, like salaries, like wages, like rent, and all of those things. So those are the key things. And I just have other description of what our assets are and what the financial element looks like. I talked about IFRS the other time. It's a global body that guides how accounting standards are being prepared, and your financial statement has components. When I'm preparing financial statement, it has components. It's the statement of financial position. People regularly call it balance sheet. It used to be called balance sheet, but it's now renamed statement of financial. That's what's the financial position of this business? Where are you financially as of today? When we speak, where are you? And what's inside that statement of financial position is your asset, your liability, and your equity. That's what I showed us before. Asset, liability, and equity. Those three items are what are in your statement of financial position. Because when you deduct your liability from your asset, it tells you where you are today, your statement of financial position. And the second component is statement of profit or loss and other comprehensive income. You see that income and expenses, this is where they come. Your total income, it comes into your profit or loss. The total expenses come here. So if your income minus your expenses, that will determine whether you are making profit or you are making loss. So that statement that shows you whether you are making profit or loss is what is called statement of profit or loss, P&L. People say P&L. P&L is P&L, it's not P&L. People call it profit and loss account. It's not profit and loss account because you can't make profit and loss at the same time. It's called profit or loss account. So that statement that you prepare that determines whether you're making profit or you're making a loss is what you call statement of profit or loss. And let me not bore you with another comprehensive income. But it's just showing your income and your expense. So those 5 items I showed you the other time, is inside these 2 items it goes to. The first 3, asset, liabilities, and equity, go into the first one. The second one, income and expenses, go into the second one. You see, the third one, I will not bore you with it. Cash flow is showing you a bit of cash flow. It's speaking from the first 2. It's speaking items from the profit or loss and speaking items from the financial position to prepare that cash flow. And that cash flow is just going to show you how you have spent your cash. And it's divided into 3. You have either spent your cash on operating activities, day-to-day running of the business, or you have spent your cash and you have spent your cash on investing activities. Either you have added more money for capital, either you have bought more, you have given out money to shareholders as part of your dividend and what have you, and financing activities. What are those activities that you have used to finance the business? Have you taken additional loan on the business? Have you bought assets that you want to use to run the business? Have you taken additional facilities to run the business? So there is just an analysis of how you have spent your cash across 3 activities. Is it an operating activity? Is it an investing activity? Is it a financing activity? And trust me, this cash flow just pick items from these first 2. Same thing for changes in equity. If there are made changes in capital, you start your business with 100 million, or you have 100 million as part of the equity. How has it changed over time? When you make profit this year and you have added back that profit into the business, so it's going to change the equity that you had at the beginning of the year. You had 100 million last year, made 20 million profits this year. You give out 5 million as dividend. You're now going to have 115 million at the end of the year. That's what that statement is just showing. Just showing how your equity has changed. And if your equity did not move as well. And then notes to the account is just explanation of every item that is in all of these first 4 lines. Your balance sheet, expense of financial position, you have these assets, you go and put a note to explain. You have this income, you go and put a note to explain. You have these expenses, you go and put a note to explain. That's what the 5th item is. So that's all what the financial statements and they look like. And those are the items that are in the financial statement. And I just gave further explanation as to which note that just explain what each of them show. Profit or loss is showing the financial performance of the business. The financial position is showing the financial position of the business. Cash flow is showing how you have utilized or how cash have moved. Changes in equity is showing how your equity has moved. And note to the account is just explaining what you have done in all of these 4 items line by line for each of your transactions. And that's all financial statement really is. And all of these ones are just further explanations and further additional discussion. This is an example of how a balance sheet looks like, the statement of financial position. This example of how it looks like. You can see that it's starting with the assets that I mentioned. Let me see if I have something to show here. Yeah. Like that. So you see that I put assets here, and then it's giving me total assets. Asset is now divided into non-current assets and current assets, which I don't want to bore you with. And current assets, you see it here. Current assets are assets that will go within 12 months. Non-current are one that will last more than 12 months. And then that's total asset. And then there's equity that I talked about. And then there's liability that I talked about. So liability is total non-current and total current. So it's really just that. And then your statement of profit or loss is showing your revenue, which is your income. And you have your total income. And then it's showing your expenses. These guys are the expenses. And every other thing are just really jargons of this. Your income and your expenses. And then takes out. So that's really what you have. And then begin to analyze financial statement. I don't think I'll be able to move to this stage because of time. So if there are questions at this point, I'll then take them. Thank you very much for listening.
Okay, thank
you,
you
sir.
very much. Can you hear me?
Yes, I can.
So thank you very much, Mr. A very good work to simplify this process for us. In fact, I think this section will be one of those sections that I will attend, and we will have something simple as this. I've always been attending events, or I've always been attending programs for business owners, especially when it comes to accounting for non-accounting founders or business owners. But the way you've simplified this is, even though you are not able to give you enough time, in fact, as a point in time when you say that this is something, I know in some places this is what some people treat for 3 days, 8 hours every day. But within a very short time, you were able to analyze this for us. And then I think there are some key things that I have to jot down within this section. Though, yes, we'll be having snippets from the section which we will later fly around. However, one of the major key points that I took note within your section is that founders or directors are responsible to detect and stop fraud in a business. Like there was during the section, you mentioned that founders
or directors or business owners, they are the sole responsible person that's supposed to detect and also see how to ensure that that fraud are not being done in business. Majority of what we know is that it is when issues start happening that we now call auditor to say, oh, auditor, come out audit this account for us, or something is leaking. But you'll be able to simplify that that CEOs or founder, that is one of their sole responsibility. Thank you very much, Mr. Kuye. So in the section, during your section, we have some questions that we would like to ask you. We will take those two because of our time. Our next speaker is already waiting, and she's also one of our very powerful person. So the question number one is that what should happen, or okay, let me take this. So the question is, at what point in time does business owners have to check the financial record for a business that has a bookkeeper or has a financial person that taking one or two things? So at what extent or at what point does CEO or founders have to check into this? Then the second question as well is auditing of account. How often supposed to be done? How often do we supposed to do it? I think we should just take these two questions. So every other questions, I think we'll have to keep it. Thank you very much, Mr. Kuye.
All right. I'll take it quickly. For the first question, the best time to start preparing financials is from day one. I know that it doesn't happen in practical terms. You really, at that time, you are still bootstrapping, you're still trying to get things done. But once you really, get out of that initial show, you're not going to get out of it quickly. So you don't need to wait till a long time when things are really gone far. You should really start preparing financials from day one. Even if you're not paying financials from day one, get your bookkeeper to start keeping the records. I always advise business owners that don't use personal funds to transact. Don't use personal accounts for that to transact. Don't use cash. Always use transfer. Worst case scenario, use transfer and put description in those transfer. You can always go back to generate your bank statement to identify who those transactions are for. But it's best that you then have a bookkeeper who then prepares monthly financial statements for you. We call it management account, monthly management account, because you need to see your numbers to be able to make decisions, to be able to know how you are performing. We call the profit or loss statement of financial performance. That's what we also call it. It's showing the performance of your business. And if you are really concerned about the performance of your business, that's not how you not prepare your numbers. Yes, I know as business owners at the top of your head, you know what your numbers look like. But it really does not end there. You need to sit down to see whether you're making money or not. Sometimes people think that when you have a lot of money, you are going to do your business well. But as much as cash is king, cash is also poisonous. Too much cash can kill a business. If you don't know, just know today. Too much cash can kill a business. And it's your management account that will make you know whether you have had too much cash or you have had too little cash, or you are just at the right place at the right time, or it's time for you to expand, or it's time for you to think of how you to cover this cost and all of that. So on a monthly basis, at the minimum, standard global leading standards that on a monthly basis, you will view your management account, you prepare management account, and you review them on a monthly basis. Worst case, every 3 months. That's worst ever. And that's 3 months I don't advise it. But on a norm, in fact, for business that are just starting up, this is something you should be tracking every week. If you, for example, you are running services, if you're tracking your profit or loss every single week, how am I in revenue this? Because you're going to have a budget and you're supposed to be tracking whether you're going in line with that budget. And you should do that on a weekly basis for startups. But for maybe you are stabilized a bit monthly, that's the standard monthly. For startups, it can be more frequent. But if you are too risky, you are not really bothered and all of those things. Once in 3 months, please don't let it pass that. I best advise you do it monthly. Sometimes review weekly, see where you are so that you can make informed decisions with it. Secondly, the audit is done annually. At the end of every year, you must prepare your financial statements because you are going to file and submit that to the authorities. Yes, because you have registered under CAMA and under CAC, and you require that you must file your financial before June of 30th of June of the following year. So if for the year 2025 now, by 30th June 2026, you must have filed your numbers. And before you can file your numbers to the authorities, you must have been audited. So audit is done at least every year, end of every year. So that's our answer question.
Okay, thank you very much, Mr. Kuye.
Welcome.
This is very awesome. You just threw another bomb into the house. The bomb is too much of cash can kill a business. I think that is a very powerful word. Thank you very much. You really appreciate this section. So for viewers,
Thank you.
again, we just had a wonderful section with Mr. Nkechi Kuye Taiwo. He works with one of the big four firms. Should you have other things to deal with him, I think you can come through Home Cable Innovate and we'll see how to connect you to him. Thank you very much, Mr. Taiwo. We really appreciate
Thank you, sir.
and we hope
All
to
right.
call you. We hope that when we call you some other time, you will acknowledge our call.
Sure.
Thank you very much, sir. So do have a wonderful
All right.
weekend.
Thank you.
Thank you.
And you too. Thank you for having me. Thank you very much. Bye.
Thank you very much, sir. Okay, so amazing. I need to appreciate those that we are still here or that you are looking at this currently. So we just concluded. So Kolade, please can you confirm people can still watch this video and the sound are clear? The sound, the video, are all of those things clear and okay? Before we introduce the next speaker. Kolade, are you there? Okay, so thank you very much. We want to have another amazing personality, and then this time around we'll have a female. You know, one of those things the adage or one of those people say now is we need to balance the equation. When we have a male, we'll be having a female as well. And this evening, we'll be having no other person. We'll be having Dr. Idara. So Dr. Idara, so sorry, I think your name, each time I pronounce it, I will always want to bite my tongue. So probably you correct me this time around. So this is one of the powerful women I've known, and then she's an entrepreneur, a serial entrepreneur. Let me share my screen while I read a citation. I'll just read brief of who she is so that viewers will know that we've gotten another powerful individual to speak to this evening. So I hope my screen is so Dr. Idara Umoete is a medical. So sorry, doctor, please forgive me for that. I know I'll be able to perfect this today. She is a medical doctor and executive director, More Health Africa. She's founder of BetSafe Nigeria. You know, many of us will have heard of BetSafe Nigeria before. This is the powerful man behind the organization. A former digital antenatal service provider and convener of Turn by BetSafe, a capacity building initiative for obstetric first responders. So she has served as pioneer president of the Young Doctors Forum of Medical Women Association of Nigeria. Amazing. She also served as PRO, National Medical Women Association of Nigeria. She is also Secretary General of Bassett People Foundation, member of MDCN, NMA, MWAN, DHN, HFP. You can see she's very powerful. And then she been involved in numerous disease control and intervention programs across the country. She's lead consultant and coordinator, Federal Government Disease Control Program through 27 LGAS impacting over million people. So you can see this is amazing thing you need to know about her. She sits on numerous boards in her advisory and executive capacity. This is one of those reasons why we have her here. You know, as I begin to read her citations, some people will have, and they will ask that, are we talking about medicine today? Definitely, we are not talking about medicine. This is Founders Growth Conference, and we are looking at founders. We want to speak to founders of businesses, and this is amazing personality we have. She has also won numerous awards, which one of it is in her work in maternal and digital health, including Africa Health Excellence Award 2024. Join me in welcoming Dr. Idara. Dr. Idara, you are most welcome now, ma.
Thank you so much. Have you finished washing me? This one you're doing, you're washing me. Can you hear me, please? Can
Yes,
everybody
I
hear
hear
me?
you clearly. Yes, I can hear you. You are loud and clear. Loud and clear, ma.
Thank you very much. Thank you very much. And good evening, everyone. I was listening to the previous speaker with rapt attention and interesting. So the time, I was supposed to have started 5:45, but I understand that the last speaker had a lot of materials to talk about. So we will try and finish this by 6:45. Okay. So thank you very much, Alhaji Mufta, like I like to call you, for that introduction. And welcome to everybody who is here, the speakers. You're doing a great job, and those who are listening. We are talking about founders, and we are talking about growth, especially if you're founding, you're doing a startup, whether it's tech, whether it is non-tech, in an economy such as ours. And it is not peculiar to Nigeria. Globally, businesses are facing a lot of what we call headwinds. There's a lot of headwind globally. Founders are struggling across the planet, across the globe. So it's not limited to Nigeria, even though we have unique challenges in Nigeria. We have infrastructural challenges which lead to increased cost of doing business. So let's suppose that you're in production and you have to power a generator to do that production. Of course, it has led to increased overhead expenses for you. We have other infrastructural challenges, road network, a lot of things that we have to pay for out of pocket. You know, in other climes, you can pay for things, you know, in installments. Here, you have to pay for a lot of things out of pocket. Then we have the electricity, you know, issue, power, access to power. We've said it before, you have to power your gen. So even those who are doing, offering services, in fact, those who are offering services, they even need the power more. They even need the power more, because those who are in production, they can schedule a time and say, okay, from this point to this point is production. Some people actually do batch production, and then the other times they can turn off the electricity. But if you're a service provider, you want to be powered. You want to ensure that you're powered, you're connected to electricity. So there's health, there's road network, there's security, there is electricity, there is access to loans and financing. Very important. There is access to loan. I'm saying it again to emphasize how serious it is. Access to loan and financing. You will see that in a lot of other clients, you hear, oh, we have these grants available if you're doing this, if you're less than 1 year in business, less than 2 years in business, less than 5 years in business. All those things are to reduce the risk of new businesses going under within the first 2 to 3 years. Because the first 2 to 3 years are very key for survival of any business. Why? That is when you need to understand the rudiments of the business. So Alhaji Mufta brought me here to share my story, and I will share my story. When we started, we were approached by so many offers. We had so many offers. And we had people, investors that came from the UAE, and they wanted to give us $250,000 just off the idea. We hadn't even patented anything. We hadn't trademarked anything. They wanted to give us $250,000. And I said, no. We had another one from the UK, a firm from the UK, and they said, okay, we should just give them our running costs for the entire year, and, you know, they will sit with us in the business. And I said, no. The reason I said no is not because I don't like money, but I understood that the business was new, and I wanted to understand the rudiments. I wanted to make mistakes without other people's money. When you have other people's money, the pressure on you is doubled. You are afraid to fail because you have other people's money. And so if you're new in business here, the first 5 years, some people say 2 years, some people say 3 years, is the time to study and find out what works and what does not work. What works, you amplify. What does not work, you reduce, you minimize. If you are doing that with your money, I mean, if you make a loss, like the former speaker was saying, you cry, you get up, you go again. If you're doing it with other people's money, you're going to answer questions. Where is that money? Especially if there's supposed to be return on investment. And that is what pushes, I came to this point speaking of grants, interest-free grants. So when there's interest, when there's expectation of return on investment, expectation of interest on facility, it pushes founders to take risks that can collapse the business. Because you're under pressure. I hope you know that you don't make the best decisions when you're under too much pressure. There should be a balance. Pressure should just be the right amount, not too much, not too little. Too much and you make mistakes that may be too costly and you may never recover from. And so one of the things that founders here struggle with is that they don't have so much access to facilities that give them leverage, that give them the privilege to make mistakes. If you look at some of the most successful founders on the planet, they made mistakes. They had the privilege of failure. It is a privilege to fail, and nobody's saying, where's my money? So one of the things that you're going to take away from here is, if you are able to run a business and you don't have anybody that is saying, okay, I need you so time. You're not under pressure for rent. You're not under pressure for basics. It's not until you have access to $10 kind of money that you are privileged. That is a privilege. Why? Because you can make mistakes. If you have people that believe in your vision, that believe in what you're building, that believe in that company you are growing, and say, okay, you know what? I typically earn 5 naira as salary. But because I believe in your company, I believe in what you can do for this company, I'm going to take 1 naira, I'm going to take 2 naira, and let's see how this goes. Trust me, you have privilege. Don't abuse it. Because those people have keyed into your dream. They've given you their time for less than they would charge. They're giving you their time so that they can join hands with you to build. And so I'm sharing my story. Please confirm if you can hear me. Can we hear me so far?
I hear you loud and clear, ma. Loud and clear.
Thank you very much. And so those are some of the challenges that founders experience in Nigeria doing a business. However, as a founder, as a business owner, it can be hard. It can be grueling. You can have a lot of sleepless nights. But one thing you should understand is any environment that you find yourself that has a lot of problems, there is potential for explosive growth. I'm going to say it again. Any environment that has a lot of problems also has the potential to grant you explosive growth. Because there's a lot of innovations you can do. There is a lot of value you can bring to the table. And I will give you an example. You will hear stories of people complaining on social media, what I ordered versus what I got. Oh, poor customer service, no refund policy. I ordered for something 2 hours ago. They were supposed to deliver it in 90 minutes. They brought it the following day, or they brought it in the middle of the night. Can you imagine, as a business, you set up and you commit to, you say your own USP is customer experience. Customer experience in the sense that if anybody orders something from you, you under-promise and you over-deliver. So you tell them you are going to get this in 4 hours. 2 hours later, it is there. The first person, 2 hours. The second person, 90 minutes. The third person, we are in an era where people are talking. People are very expressive. Before you know what is happening, they are talking about you on Twitter. Oh, if you want this, use these people. They are so reliable. They are so this. Oh, they are so that. They are carrying your market literally on their heads. So I'm talking about an environment where there is a lot of problems. There are a lot of problems. Many problems equals to many opportunities. However, it can be harder. We are not dancing around this one. It can be harder. So what are the things that you could possibly do to increase your chances of survival? You're a business under 5 years, or maybe you're a business over 5 years, and you're trying to scale. Every business wants to scale. That's the buzzword right now. Every business wants to scale. And then you go to all these beautiful business summits and workshops, and everybody says, oh, structure, 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 structure. Fantastic. For me, what I would say has helped BetSafe is that we understood our USP. We are user-centric. So it was never about me as a doctor. It was never about what I wanted to see in my patients. It was always about what do they want. If you're not taking anything away from anything I have said, please find a way to get feedback from your users. Your users are your most important stakeholders. Find a way to get, even if that feedback is horrible, it doesn't matter. Find a way to get feedback from your users. What are they saying? What are they complaining about? What are the things they don't like? What are the things that they are angry and frustrated about in other brands? My users poured their frustration on the hospitals or me. Oh, I go to hospitals, they don't listen to me. They don't talk to me. They don't explain this. They don't explain that. I was noting everything down. I was noting everything down. Oh, they don't tell me this. Oh, they don't tell me that. Oh, I don't want to have this. Oh, I don't want to have that. I was noting everything down. Every single one of those pain points, we aggregated them. Every single one of those complaints, we used it to build a very robust protocol library, which formed the basis of our app. And pregnant women subsequently would come in and say, how did you know we were listening? Oh, my hospital doesn't do this. This is so comprehensive. We were listening. Oh, I'm based in the UK. I'm based in America. They don't teach me all this kind of thing. We were listening. If you can listen to your users, if you can find a way to get feedback from your users, you have already edged 50% of your competition. You have already done 50% of the hard work that you need to put in to put your brand out there. Don't worry whether it blows immediately or it doesn't blow. It's a matter of time. So the first thing is you must be user-centric. Starting out, you must find a way to keep your costs down. You must find a way to keep your running costs, your overhead expenses as minimal as possible. Remember I said that we're offered all sorts of grants, all sorts of loans, and I said no. I said no. I'm sure you've seen and heard stories of founders. Oh, this one raised 1.4 million in funding, $1.4 million in funding. This one raised $500,000 in funding. This one, 2-3 years later, where are they? Otilo, they are gone. The previous speaker said something. Sometimes too much cash can kill a business. When I heard him say that, I smiled. Because if I had gotten an injection of too much cash into BirdSafe very early, a lot of things we know now, we wouldn't have known them. A lot of things we're able to do, we wouldn't have been able to do them. Not because we didn't have the money, but we'd have just been throwing money instead of being the innovative brand that we are. So you must be careful. You must be careful starting out. You're starting out with your users. If possible, sit down in the trenches with your users. What do you want? How is it doing you? Where is it paining you? How can I help you be better? Because I exist, how can you go to bed and smile? In your mind, that is what should fill your mind. How can somebody wake up today and smile because I exist? How can somebody wake up today and their lives are better because I exist? That's why you exist as a business owner. Whether you're into products, whether you're into services, whether you're into tech, you exist to make other people's lives easier and better. So if somebody's life is not easier and better because you exist, why are you doing business? I know people say, oh, the purpose of business is to make money. But there is a way you make money, and because you are solving a problem, you are so good at making people's lives easier, it's as if the money is running after you. So you don't have to try so hard. You are crying about this situation. Oh, you are crying about shoes that you cannot find your size. Try this one now. Oh my God, I'm wearing these shoes and they don't hurt. You have wiped that person's tears. That person will call their father, their mother, their sister, their brother, everybody. Come and see, oh, this person helped me. So whose problem are you solving? Can you sit down and ask yourself that question every time you wake up, every time you do an analysis? Have I solved anybody's problem? Is someone out there, is a brand out there happier because I exist? So one is user-centric. I'm just going to talk about 3 things. Number 2, collaboration. When we started, we sat down and we identified where pregnant women pull. And we found out, the people who host those kind of communities. And we said, oh, let's give you this for free. Let's give you this for free. Talk about us. Let's give you this for free. Let's demonstrate, okay, we can do this for you. We can do this. Collaboration. Because people cannot seek you out if they don't know you exist. It's simple. People have to first know that you exist before they say, come and help me solve my problem. If they don't know you exist, how are they going to say, come and help me solve my problem? So as part of the awareness drive, as a founder, you must be almost aggressive about making the people who need your solutions know that you exist. You must almost be aggressive about it. It is the lifeblood of your business. Advertising, it is the lifeblood of your business. Whether you want to advertise organically by making content, or you want to advertise organically by collaborations, or you want to advertise, using paid media, buying ads, by running adverts. But you must make your users aware that you exist. You have a problem, I am here. You are hungry, I have food to give you. What would you like to eat, ma'am? That is your job. And so when you find yourself in that space, and that's why I said always consider it a privilege if you have people that key into your vision and say, okay, I'm here to support you. As a founder, there's different types of founders. But if you're an innovative founder or you're a marketing founder, you want to be sure that very quickly, as much as possible, you get somebody into your organization that understands operations. Why? So that you can focus on getting the word out that your business exists. That person, that other person, whether a co-founder or an employee or a member of the team, will now be focused on servicing the business. You are focused on promoting the business. You promote, they deliver the service. You promote, they deliver the service. Excellent combination. When we started, I was initially hesitant to throw so much money into advertising. And this is why coming for sessions like this and summits like this and conferences like this is very helpful. This is what helped me. I went out and I attended a lot of summits, and I would hear people say, oh, in 2023, as at that time, in 2023, oh, I ran ads to the tune of 23 million. Oh, really? You are not Coca-Cola? You're not Pepsi? You're not? You say, yes, now. And I got everything back. The more you keep hearing those kind of things, it loosens something in your mind. It loosens something in your mind. You will understand that to receive, you have to give. To receive that return on investment you're looking for, it means you must make an investment. You cannot be expecting a return on investment if you're not making an investment. So every week, every month, every period, every quarter, how much are we allocating to making people aware? How are we doing it? Are we using influencers? Are we running ads? Are we shooting content? What are we doing exactly? So I've talked about being user-centric maybe in terms of innovation, creating unique products, in terms of customer experience or something, but being user-centric. I've talked about the A in IDA. Your job as a founder is to have people aware of what you're doing. And then the third one is that you pace yourself. You will attend a lot of summits and conferences where everybody's talking about structure. You need to have a CMDs, you need to have a CFO, you need to have a this. Pace yourself so that you don't structure yourself, you don't structure your business on underground. Your business is talking to you. When it gets to the point where you need a C-suite executive, that's what they are called, a C-suite executive, you will know. But when you are starting, you just need maybe something lead, operations lead, partnerships lead. No, don't be in a hurry to say, I want a C-something. A C-suite executive is not designed to be in the trenches. A C-suite executive is designed to oversee people under him or her. So you must get those under him or her first. You must get your leads. This person is an associate, this person is a lead, this person is a this person is a that. Who are the people you need in your team? You need a solid marketing team. It may be one person, it may be two persons, doesn't matter. Two persons, it doesn't matter. Whether one person or two persons, they should be your media machine. They can churn out content for you. They can write fantastic copy. Someone there can run ads. Please note what I'm saying. It may be you. It may be someone that you engage. They can write content for you. Have you seen in today's world of business, content is king. If you don't have it, go and find it. Go and find it either in yourself or someone that can bring that kind of value. Two people, one, either two or one, someone that can deliver great content. Fantastic copywriter, do great content, has an eye for content, can catch on to what is trending and key you into it, and someone that can do ads for you. So that could be you, that could be outsourced. Then you need operations. You need operations, non-negotiable. An operations person, a true operations person is someone that can take the goal and break it down into many, 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 many different parts, to-dos. I want to host a founders growth conference. What do we need? We need facilitators. We need a platform. We need data. We need timing. We need this. We need that. Timeline to this. Who does this? When do they respond? Like that, like that, like that. That is who you need. So when you combine the ideas in your head, the innovations in your head, with great awareness, great promotion, and then service delivery, those three things, every other thing can build on top of it. Every other thing can and will and should build on top of it, but ensure that you're user-centric, you're creating a product or a service that satisfies your customer. You owe nobody any loyalty but your customers, your users. The second one is that you have a system in place, either you or you have outsourced it, to make people aware of what you're doing. You cannot be creating a fantastic service and you've spent all this beautiful energy creating something beautiful, and then you fall short on letting people know. No, you must blow that trumpet. Are you seeing, oh, we are doing great work. We are doing amazing work. Are you for real? You are hungry. You've not eaten our food. If you've not eaten our food, you've not eaten in life. And then thirdly, someone who delivers the experience that you promise. Someone who makes things happen, an engine room. An operations person is the engine room. When the customers come, is everything in place? Is the production producing? Is the service servicing? The things needed to get the service out, the product out, are they happening? If you have those three, despite the challenges in Nigeria, despite the deficiencies with our access to infrastructure, you will be well on your way to surviving the first 5 years of business. And when you survive the first 5 years of business and find out what works for you and what does not work for you, you can then really begin to amplify and scale and do fantastic things in your business. I hope this was helpful. Thank you very much for your time today.
Amazing, amazing, amazing. Please, I want digital appreciation. I want us to digital appreciation, please. If you are still here, please, can you help? Also, please, can you confirm you can see me? Thank you very much, Dr. Idara. Dr. Idara, please help pronounce your surname well, please.
Umoite. Umoite.
Umoite.
It's like saying Umoino. Umoite. Umoino. Umoite. That.
Umoite.
Yes.
Okay, thank you very much, Dr. Idara Umoite. This is incredible section. Sincerely, within this short period of time, she chose to bomb into the house again. This section has been very, very powerful. Fourthly, one of those things we need to note that she said is that every business needs to learn when to accept or reject fund into the business. I think that is very powerful and stand as one of the key things we need to take home today. Every business needs to know when to inject or reject money into the business. That's the first thing she mentioned. She also mentioned that it is very necessary for business to understand their unique selling proposition. She also talked about getting feedback from users, that when you listen to users, when you listen to clients or people you want to serve, then you will be able to look at or you're able to create a perfect solution or a product for them. Then she also talk about collaboration, that in collaboration really help and it will really amplify business growth. But yeah, our section or our topic has been tagged strategies to win bigger business goals, strategies to win bigger to win bigger business goals. And you can see that all of these things that she has said are fantastic things. Uh, one of those things she also said is about collaboration. Collaboration is very, very important in every business. And she shared the journey of her business when they were starting out, that at a point in time, they need to collaborate with some necessary individuals. I was talking to, it's just part of the strategy. I was in a room with one of the one sales coach, and said for 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 bigger, when we had, is it Big Cola now? Yes, Big Cola. When Big Cola came into the industry, one of the key things they did was to identify the one of those people that can help them sell better, and they look at what can we do to these people to accept our products in. This is Big Cola. This is fight between Big Cola and Coca-Cola. No, when Coca-Cola came into the industry, when Coca-Cola has been in the industry, but when Big Cola came into the industry, one of those strategies they did, because then they were very attentive to their users or to their target audience. They know that, okay, these people, they want something unique. And one of those things they brought into the industry was that they have something big. What's happening? Okay, sorry, my light just went off. So they brought in something big into the industry. So please, a minute. So please, okay. So let me just find it before this is being restored. So they had tried that. So another thing they did was they knew that one of those key things or one of those key people or one of those key partner in their business is those people that sell on the highway, like express road. So those people, what they had did was their products, they were selling it at a price. At that time, I think Big Cola or Coca-Cola was selling for 120, 120 or 150 naira. So what they did was they were selling their own at 100 naira, at 100 naira. And before you know it, anybody that wants to buy the product, 100 naira, immediately they pay and they collect their money, they give deposit and need it. So it is very easy for that to, and that is one of those key things they did to penetrate the market, apart from the size of their product. Apart from the size of their product, when Coca-Cola wanted to react to that strategy, they went and introduced another size, they not another lesser size that was not selling for 18 naira. They want to introduce another side. They thought money is the issue with people. So they introduce another side for 120 or 150 then. They introduce another side for 18 naira. When they introduce that price for 18 naira, people were Big Cola. Why? Because it's easier it is one of their partner. They look at how can they collaborate better with these people are in traffic, they are selling, talking and they are selling. So one of those things is what they collaborate effectively. So thank you very much, Dr. Idara. So they were very keen to collaboration. So who can you collaborate with to assist your business? It's very, very important. She shared a very perfect example as it relates to her business. And she also talked about, she notes some key three things that every business have to take note of. One of them is you need to create awareness of your brand. And what she shared that in your operations, before you start talking about business, one is a marketing. who is in charge of your marketing, who is in charge of your marketing. And in fact, okay, today we are not telling you, or we are not telling our product to you, but however, we have a product for business owners who want to franchise their marketing or their branding service out. So you can talk to us. What do you need? Do you need to create design for your business? Do you need to share content? You need to have a content calendar for your business. We need to, so those are part of those things we do. If you know you can't hire, you don't want to hire somebody who just be a graphic designer, you want to see hire somebody who will do your who will own your ad, you can actually franchise this out, and that is where we can also come in. Okay, we can come in into that. So she also make mention of your operations. Who are in charge of your operation? How do you action to your operation people? So thank you very much. This section has been very wonderful, wonderful. And we have some questions for you already. I note some of those questions. So can you see me, doctor? So can you see me, doctor? Dr. Idara?
Yes, I can hear you.
Okay, thank you very much. So the question is, how do company manage when you have a staff and is when you want to employ the staff, some people will say you need to have SOP, you need to even you even need to work in new staff onboarding process. You need to work them into the process of your company and your standard operating procedures. And one of those key things we know that to create some of these things is somehow expensive. How can small business do this? Small business is just starting to create all of these things. What can you advise small business? And another question I will take two as well because of the time. So another question I actually note here is, so sorry, I have a lot of questions, but we'll not be able to answer that. So another question someone also asked is, how do you ask a staff stealing from the business? What do you do in that case? What do you do? So those are the two questions I want you to answer because of our time, sir. Thank you very much, Joseph.
Okay, so I think I'm going to start from the second one. The second one is, how do you, if I heard correctly, how do you stop staff stealing in the business? Did I hear that correctly?
Yes, ma'am.
Okay, so the simple solution to this will be record keeping. It will be record keeping, it will be bookkeeping, and there are a lot of tools, there are a lot of software tools that can help you track inventory. So if you just go on the internet and check for inventory management tools, you will see a bunch of software that can help you note, okay, how many bags of flour, for instance, how many bags of flour did we buy? You must also be good with numbers. You must also be good with numbers. How many bags of flour did we buy? These bags of flour are supposed to produce how many cakes? How many cakes actually got produced? So I understand that it can seem a little bit overwhelming, especially in a business that requires a lot of moving parts. So if you're into production, let's say you make cakes, you need to get flour, you need to get butter, you need to get sugar, you need to get so many things. An inventory management system will help, because then you can keep track of outputs versus inputs. You have an expectation, and then you have a margin of error. If it goes beyond that margin of error, something is wrong. You must make provision for attrition, give or take 5%, 10%. So if a bag of flour is supposed to make 5 cakes, you can say, okay, it can do 4.5 or it can do 4. So if that one bag of flour does not do 5 cakes, it doesn't do 4 cakes, it does 3 cakes or 2 cakes, no, something is wrong. So the first thing is to get an inventory management software or tool or system, so that everything that is coming in versus everything that is going out should be tracked. Secondly, checks and balances. So you see there are some supermarkets where the staff are not allowed to have their phones on them. They're not allowed to bring, even you as a customer, you're not allowed to take in your bag. All those things are for checks and balances, so that it reduces the risks of you taking things from the shelf and putting in your bag and going. So you will look at your unique business and see the checks and balances that you can install, the measures that you can put in place. The number one tip is, as much as possible, identify how to cut out from amongst your staff direct access to cash. I will say it again. As much as possible, identify how to cut out, as much as possible, direct access to cash. So if someone is supposed to run adverts for you and is a member of your team, don't give that person the money to fund the ad accounts. Give another person the money to fund the ad accounts. Go ahead and run the ads. Someone is supposed to buy fuel. Don't give that person the money to buy fuel. They will complain and say, oh, it's too much bureaucracy, it's too much checks and balances. So the person that is supposed to buy the fuel is not the person that is handling the cash. Another person entirely buys the fuel. Another person, possibly in another unit, maybe operations or something, buys the fuel. If possible, establish a relationship with a fuel station. So if you have a relationship with the fuel station, every week you're going to give me 20 liters of fuel. The driver just goes there and he picks it up. So if the driver is supposed to fuel the vehicle, you have some sort of document that is sent to whoever is keeping your books. At this time, 20 liters was dispensed or 50 liters was dispensed, not into a gallon, directly into the vehicle. If it's into a gallon, when the person comes, they check it and assess that is actually 50 liters. You can't be tired of checks and balances in your business. And when you're doing your checks and balances and balancing, do it, let it be clear that you are doing it, so that there's no complacency. It should be clear, it should be obvious that you're doing it. Do periodic ones, do scheduled ones, and do sporadic ones. That sporadic ones is very useful for keeping team members on their toes, for keeping staff on their toes. So let's say you typically do inventory, take stock of inventory every end of the month. Wake up on a random Tuesday in the middle of the month. Okay, let's check what's happening here. We bought 5, we bought 15, we sold 5, we should have 10. 1, 2, 3, 4, 5. Why is there 9? What happened? Randomly, that will help to reduce theft. It will help to reduce fraud in your system if you're into production. The other question I had, the number one question, could you remind me, please, the first question that was asked?
About SOP or setting.
Yes. So SOP.
And onboarding.
Yes. About onboarding, that one is a piece of cake, a piece of pie now. Why? Because of AI, artificial intelligence. You can use Sintra. You can use Meta. You can use Grok. You can use DeepSeek. You can use ChatGPT. When you get, but this is the key. I always tell my team members that ChatGPT is not more intelligent than me. My brain is far superior to ChatGPT. I tell them all the time, because I'm not willing to outsource my brain to ChatGPT. So whatever it gives you, you use it as a template and you customize it for your business. Because AI will always tell you the information you're getting can be incorrect. The information you're getting can be wrong. SOP is very easy. What do I need an operations person to do? First of all, you go and sit down. You ask Google, what is an operations person supposed to do? A, B, C, D, E. Tell me how to create. You have to customize the prompts. I am a farmer in Ibadan who has a poultry farm that makes about 500 eggs every day. And I need an operations manager to ensure that everything is going well on this farm so that I can deliver service? What is the kind of SOP that I will need for an operation? You have customized it down to the last detail. If you can customize it like that, the chances are very high that what ChatGPT will give you will be what you need to get your people, to get an SOP, to get onboarding documents that help you actually see some value from the people that you onboard and the people that you engage. So the key is to put out the right information into AI. When it still comes back to you, sit down and customize it for your business, and then you'll get the results that you need.
Amazing. Thank you very much, Dr. Idara.
Thank you.
This section is very, very powerful. And I hope all those of you watching, you really gain a lot from this section. Okay, yes, this replay will be available. This section will have replay available. So you can watch it later. So we'll try to upload that. Meanwhile, before we ask Dr. Idara, thank you very much. I think towards the doing the conference that is also AI and as it relates to business. So I'll be speaking to that actually as it relates to your business and branding. So I'll be speaking to business on that. Meanwhile, before Dr. Idara take her leave, and before we call it a day, we're actually doing we are closing it down already. I had to tell all of us to, for those of you that you've been interested, I think this is something very powerful. You can actually recommend. So Dr. Idara, the speaker that just spoke, will be having an event soon. I want to look at it. So I'll be sharing that now. I just want to play the video, so that you can get the information. Then you can. So I will also attach a link to the Instagram and other places you can register or you can benefit from this event. I will also to this replay later on. And if you do have somebody that is interested, I think you can. Somebody definitely showed you this video, or somebody show you that this webinar is taking place. So please let me play that. Please, can you please play that now? Okay, so
From July 2022 to date, we have served directly over 10,000 women across 26 countries, helping them to birth their babies without complications in pregnancy and childbirth. However, in the course of our work, we have noticed that results are better when our trained pregnant women encounter experienced first responders in the hospitals who know what to do to ensure that in the event of an emergency, they and their babies are okay. And this is what gave rise to what is called the TOM campaign, Train One, Reach Many. Hear from some of our nurses.
It's a campaign that is being hosted by BirthSafe Nigeria. LLB to reduce maternal and fetal morbidity and mortality. You can save one life or even two. You knew just what to do as a qualified nurse and midwife. Take advantage of this opportunity. I will be there. See you at TOMS.
If you are a registered nurse midwives, then this program is for you. Just click on the link and make sure you come around and attend the event.
You have heard from the nurses. And so, if you are a brand, an organization interested in championing and advocating for the well-being of women and babies through the journey of pregnancy and childbirth, we invite you. Partner with us in BirthSafe Nigeria to train one nurse to reach many. Thousands of women and their babies are going to be saved in pregnancy and childbirth because we have trained one to reach many. Join us today.
Okay, so thank you very much. Again, this is a section you will all want to pass out. For those people, definitely this is for nurses. So if you have a nurse close to you, you can give this to them, nurses or midwives. So this is for them. And in fact, I love the name of the outreach of the campaign, train one to reach many. That's amazing. That's amazing. So you can share this with them. Then for organization founders, if you want to partner or you want to support this initiative, I think you can reach out to see how you can be of help or how you can partner with this initiative. This is something you will, when you train someone to give the best to people, how many people, in fact, how many people can we count the number of women that have their pregnancies? So these are part of those things that we want a better future about. So no one pray to have a loss doing labor. So we pray God will reach every person that wants to support, or every founders or organization that want to partner with this organization. And then Dr. Rara, you are doing amazing work. We really appreciate. And then this is a good this conference again. We've had enough time. This is more than 2 hours looking at businesses, looking at business scaling and what you need for your business. I'll be wrapping up today. So join us next week by 5 p.m. for another. Thank you very much, Dr. Idara Umoite. So we really appreciate you joining. Your knowledge of experience shared, we really appreciate that. Thank you very much. So join us next week at 5 p.m. We have another amazing personalities, another amazing guest who will be talking to us about business scaling and what your business needs. So till then, we say thank you very much. We really appreciate all of you that have been supporting, all of you that shared this section. And you can click on this video to subscribe. You can subscribe, you can like our page, and so as to not miss any of other amazing opportunities we'll be bringing on board. Thank you very much. We look forward to having you next week. Same time, 5 p.m. to 7 p.m. Thank you. We meet next week. Bye.